Top 7 Investing Tips from Warren Buffett. Warren Buffett is known as one of the best investors of all time, and he has amassed more than $100 billion fortune through his company Berkshire Hathaway. But he's not only a great investor, he enjoys sharing his wisdom with fellow investors. Number 1. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. Buffett points sounds simple here, but it's complex. Of course, as an investor, you're trying to profit in the market. But one of the best ways to do that is by avoiding loss. When you eliminate decisions that expose your portfolio to loss, what's left is more likely to be a gain. When you have more money in your portfolio, you can compound your gains even faster. This approach has implications for how you invest. Buffett's quote suggests that instead of looking for the highest upside, you should be looking to avoid loss first and then only look at gains. That's a different mindset from investors who view the stock market as a slot machine. Number 2. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. While some value investors focus on buying only the cheapest companies, Buffett suggests a better course of action is to buy wonderful companies, those with better economics and competitive position. Part of the difficulty here is that whereas fair companies may go on sale relatively frequently, the great companies rarely look cheap. But a company with a good competitive advantage will likely continue to make money over time, and it can bail you out if you purchase at a too high price. This may not be the case for a fair company, which may plateau and never return to your purchase price or beyond. Number 3. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. While some investors think investing a lot about the numbers, Buffett suggests that investing has much to do with the behavior of investors themselves. When investors are greedy and push the prices of stocks to the sky, Buffett becomes fearful because a market plunge may soon follow. In contrast, when investors run away from the market or a specific stock, Buffett becomes more interested because prices are cheaper. When stocks are cheaper, they don't have the same risk as when they are expensive. And this is how Buffett thinks about avoiding losses. In early 2020, the market plunged as worries about COVID-19 rattled investors. However, some investors dove into the market amid the fear, and the market rallied furiously off its lows. Number 4. The stock market is a no-call strike game. You don't have to swing at everything, you can wait for your pitch. This quote is one of Buffett's most famous, and it offers the essence of picking your opportunities. You do not need to invest until you find an opportunity that you find attractive, one that meets your standards of potential reward for the risk you are taking. Again, Buffett counsels investors to wait until they find an opportunity that is unlikely to lose them money. You don't have to take any chance on a stock that you don't find attractive or a business you don't understand. Number 5. Start small and be patient. Buffett didn't start with millions to invest or a social media platform to grow his wealth as an investing expert influencer. He described his early days as working with a tiny amount of money, when he would choose a promising small companies and invest in its growth. He believed this freedom to choose small company makes small-scale investing powerful. More importantly, anyone can follow this advice. Choose an affordable company you believe in and then wait for it to work its magic and make lots of money. As Buffett said at the 2001 Berkshire Hathaway annual meeting, I think if you are working with a small amount of money, you can make very significant gain. Number 6. Invest in index funds. In Warren Buffett's view, for most people, the best thing to do is own the S&P 500 index fund. Index funds are investments that track the return of a market index, representing a particular section of the stock market. The S&P index is one such example. The S&P 500 includes 500 companies in various top-performing industries. Its broad representation means you are not tying your funds to a tiny slice of the economy. Buffett likes it for everyday investors because it is simple yet effective way to spread your money around. The relatively low risk of this investment is backed by this famous Buffett quote. The first rule of an investment is don't lose money. And the second rule of an investment is don't forget first rule. And that's all the rules there are. Number 7. Understand your investment. Risk comes from not knowing what you are doing. Knowledge is power when it comes to your money. You don't need to know everything about the market or the industry you are investing in. Most people would never be able to invest if that was a requirement. You do need to understand the basics of how an investment works. You've already taken the first steps by learning about index funds and bonds. If you have another investment interest, start researching it. You can always ask a financial advisor for help if you need it. I hope you like the top 7 investing tips from Warren Buffett. Please like and subscribe if you like the content. This will motivate me to create more and better content.